Imagine receiving a notification on your phone that you just received a $700 payment hit your bank account. This payment wasn't from your job, you didn't have to work overtime for this, and in fact, you didn't have to work at all for it. This was my reality just a few weeks ago, and it was all made possible because I invested into dividend paying stocks and ETFs. Now, dividend investing might just be the perfect strategy for those of us who are aiming for early retirement in Australia, because they are one of the truest forms of passive income. So in this video, I'm going to give you a step-by-step guide on how to get started with dividend investing, and by the end of the video, you'll have everything you need to know to get the ball rolling. And make sure you stay till the end, because I touch on a critical mistake that most beginner dividend investors make, which you'll want to avoid. So the first question that we really need to ask is, what the hell even is a dividend? And surprisingly, it's pretty straightforward. So when you buy shares of a company, that makes you a shareholder of that company, which means you technically are a part owner. And companies oftentimes make profits, and a dividend is a share of those profits that a company distributes to their shareholders. It's kind of like your share of the company's success. Now, with all that being said, why should you even consider dividend investing over, let's say, a growth stock that doesn't pay dividends? Well, firstly, with dividend investing, you can take advantage of something called compound interest. This is where you earn interest on your own interest. But in this case, it's dividends on your own dividends. Now that might sound a little bit complicated, but let me explain with a simple example. Let's say you invested $1,000 and you get a 10% return. Now at the end of the year, you're going to have $1,100. Now, when you start that next year, if you get another 10% return on that $1,100, then you'll end up with $1,210. And now pretend that pattern continues for another 20 years, your money will continue to earn money on the previous balance every single year. So at the end of year 20, you're going to have $6,727. So just by investing $1,000 and then getting a consistent return year after year, your money begins to grow and grow and grow. And that's what we call compound interest. And the same rules apply to dividend investing. You see, with dividend investing, you can actually opt into what's called a dividend reinvestment plan, which essentially means that any dividends that you receive automatically get reinvested to purchase more shares of that same company. Reinvesting into more of these dividend paying stocks essentially will compound your returns over time. Albert Einstein once said that compound interest is the eighth wonder of the world. He who understands it, earns it. He who doesn't, pays it. Secondly, studies have actually shown that dividend paying companies outperform their non-dividend paying counterparts over the long term. Now, it's not to say that it will be like this forever, and it's definitely not to say that there are no exceptions to this. But a recent study done by Bloomberg found that when you compare the ASX 200 index with companies who pay a high dividend, they have historically outperformed their non-dividend paying counterparts. And this is before we include the impact of franking credits, which only increases that margin of outperformance. Okay, so now that I've explained why you might want to get into dividend investing, the next question is, what should you invest into? And you essentially have two different directions that you can go for. You can either invest into individual companies one by one, or you can invest into what is called exchange traded funds, or ETFs for short, which essentially is like a big basket of stocks that's made up of different companies that you can then buy all bundled together instead of having to buy each one individually. Now, there definitely are pros and cons to each of these. With ETFs, the dividends are going to be more on the stable side, and you're also able to diversify yourself because you're essentially buying a mix of companies and collecting their average dividends. However, there isn't going to be as much growth because if the stock price of one of these companies increases dramatically, it's not like your whole portfolio is going to go up as well, because it only makes up a small portion of that overall basket of stocks. Now, with individual companies, these are going to be more volatile, but there is higher potential for growth not only in the company's stock price, but also in the dividend payouts. But with investing into individual companies, you're going to need to do your own research to ensure that you're investing into high quality dividend paying stocks. Whether you pick stocks or ETFs, it's going to be up to you and your own personal risk tolerances. But I would say that the general consensus is that ETFs are the much more safer route simply because you're instantly diversified through buying that one ETF. But let's say you do want to invest into some individual companies. What are some key metrics that you should be looking out for when you're deciding which company to invest with? As a beginner, there's definitely a few key dividend stats that you're going to want to be aware of. And so we're going to be looking at the dividend stats of Telstra, and I'll show you them using the MOOMOO app. The first of which is the dividend yield. This number represents how much income that you should expect to receive from a company's current share price. And as a dividend investor, this might be one of the most important metrics that you're looking out for, given the fact that you're investing for those dividends. And to calculate the dividend yield, you would essentially just take the annual dividend paid per share and then divide that by the company's share price. So for example, if a company paid $3 in dividends and its current share price is $100, it would have a dividend yield of 3%. Now, Australian companies generally have paid far higher dividends than other markets around the world. So generally, dividend investors will want to aim for a dividend yield around the 5% mark. And so when we look at Telstra's, it's sitting at around about that 4.7%, which is within that vicinity. The next metric is the payout ratio, as this tells us how much of a company's earnings are being paid out as dividends. And you calculate this by taking the annual dividend paid per share divided by the company's earnings per share. So for example, if a stock paid $3 per share in dividends and earned $6 per share, the payout ratio would be 50%. Telstra has a payout ratio of over 95%, which tells us that the company isn't really keeping any of its profits for itself and isn't really reinvesting back into the business because it's paying out most of its earnings as dividends to its shareholders. This can be seen as good or bad depending on who you ask, but it also depends on the context of the company itself. A high payout ratio can be seen as bad because it means that the company isn't reinvesting a lot of the money back into the business, meaning there isn't as much room for future growth. But for a company like Telstra, that's literally a cash cow business, it doesn't actually need all that money to be put back into the business. So it can very much easily distribute most of its earnings to their shareholders as dividend payments. The last metric to be aware of is the dividend history, which helps us see the payout consistency and dividend growth. Usually we look at it over the last 5 years, and dividend growth is definitely something that you want to be tracking because it literally means that you're getting a pay rise for doing nothing. In the case of Telstra, we see that they decreased their dividend back in 2020, but have since then kept it pretty consistent, and over the last 2 years have actually grown it quite significantly. So with all that being said, what do you need to do to officially get started with dividend investing? Well, step one is that you need to choose a brokerage account. This is where your portfolio will be held and also the platform where you're going to buy and sell your dividend paying companies. Now, there are a lot of different brokerage platforms on the market in Australia, but I personally use the MOOMOO app. I prefer trading with MOOMOO because not only are they a low cost broker, but they're also a CHESS sponsored broker as well. They also empower you with all the analytical tools that you would ever need. For example, there's a dividend screener that you can use to help you find high dividend yielding companies that not only consistently pay a dividend, but grow their dividends. So if you wanted to get started with MOOMOO, they're offering new customers who sign up to 10 free stocks valued at up to $3,300 when you deposit at least $2,000 into your brokerage account. You can check them out using the link in the description down below. And so finally, what's the most common mistake to avoid as a beginner dividend investor? Now, whilst the company's dividend yield is extremely important as a dividend investor, the last thing that you want to do is to just go out there and look for companies that have the highest dividend yield possible. If we look at AGL back in 2019 to 2021, they had a dividend yield between 7 to 12%. which would have had dividend investors salivating at the mouth. But if we look at the dividend yield today, it's now just sitting at 2.91%, which is well below the average of what we'd expect to see in Australia. The payout ratio is also minus 10%, which means that the company actually has negative earnings. And if we look at the dividend growth rate, we can actually see that they've been slashing their dividends year after year, which is obviously the opposite of what you want as a dividend investor. And we call these companies yield traps, which are essentially stocks whose dividend yields are extremely high, but are actually too good to be true and unsustainable. And as a dividend investor, this is something that you want to avoid at all costs. So let me know what your thoughts are on dividend investing. Do you like dividend investing, or do you prefer growth investing? Personally, I like to mix both of them together. However, I'm definitely more focused on growth investing right now, given that I'm young and my earning potential is at its highest. However, later on in life, I will definitely start to shift more of my investments toward dividend paying companies to take advantage of those great franking credits. If you have enjoyed the video or learned something new today, make sure to hit that like button down below and subscribe to the channel for more content like this in the future. And if you're interested in learning about how much you need to have invested to actually live off dividends, then you might want to check out this video right here.